Hi, my name is Weiren, Senior Portfolio Manager at iFAST. Today, I'd like to give everyone an update on the performance of our iFAST DPMS portfolios for the month of November. Global equities were actually on track for another month of positive gains in November, but the emergence of Omicron in the last week of November negatively affected investor confidence, and that led to a sharp decline in global equity markets. As a result, the MSCI AC World Index was down by 1.1% in November. The US equity market outperformed, with the S&P 500 ending the month in positive territory despite the market volatility we've seen in November. And that's mainly driven by semiconductor stocks, which rallied in November, not just because of their solid fundamentals, but also the emerging metaverse has added to optimism that future demand for semiconductors could continue to increase. European stocks fell sharply. Omicron was, of course, a contributing factor, but even before the discovery of Omicron, Europe was already struggling with a resurgence in COVID-19 cases, and sentiment was affected by the prospect of fresh lockdowns that could derail the economic recovery. Japan initially rallied in November because it started to ease some of its COVID-19 restrictions, and there were also expectations for aggressive fiscal spending to help stimulate the economy. But Omicron came, and the government had to reverse some of its border easing measures. Asia and emerging markets also underperformed. China was down by 4.8% in November, while Latin America and EMEA markets were also down for the month. Digital economy stocks saw a sharp sell-off in November as investors started to price in the possibility of tighter monetary policy. Fixed income markets were mostly down in November as the prospect of tighter monetary policy dragged down the performance of global bonds. Although global bonds recovered some of their initial losses after the discovery of Omicron, they still ended the month with losses of 0.3%. The worst performing fixed income segments in November were mainly the higher risk credit segments, which includes your emerging market bonds as well as some high yield bonds. Asian high yield initially rebounded strongly in November as there were signs that the Chinese government was easing some of its tough property measures to prevent contagion, but the risk aversion towards the end of the month meant that Asian high yield bonds ended November in negative territory. In terms of our portfolio performance, our portfolios delivered losses of between 0.8% to 1.7% in November, and we have also underperformed our benchmarks over the month. And this is largely due to our exposure to Asia and emerging markets, which has underperformed global equities. We also have exposure to digital economy stocks, so that has also affected our portfolio performance. On a year-to-date basis, our portfolios have delivered returns of between a negative 1.5% to 4.6%. And since inception, our portfolios have delivered annualized returns of between 3% to 10.4%. We actually started off the year with our portfolios ahead of our benchmarks, but regrettably, due to our underperformance this year, our portfolios have once again fallen behind their benchmarks. We did not make any changes to our portfolios in November. In terms of our inter-asset allocation, we remain overweight equities relative to fixed income. We expect the global economic recovery to continue into 2022, and that provides a favorable backdrop for the performance of equities. On a relative basis, the valuations of equities are also more attractive compared to bonds. With the exception of the US equity market, the valuations of most equity markets are still reasonable. In a fixed income space, there are selective opportunities, but the reality is that a significant proportion of the fixed income market is currently offering limited value. And with increasing evidence that inflation is far from transitory, we expect the Federal Reserve to start hiking interest rates in 2022. And that also means that the fixed income assets could be vulnerable to price declines. In terms of our intra-asset allocation, for fixed income within the investment grade space, we are overweight the shorter duration Singapore-centric bonds. Our base case right now is for the Federal Reserve to hike their interest rates in 2022, and this means that we will continue to maintain a short duration profile for fixed income because shorter dated bonds tend to be less sensitive to interest rate increases. Within the higher credit risk segments, we are underweight both emerging market bonds and global high yield. But Asian high yield, on the other hand, looks very attractive at this point. The significant correction that we have seen over the past few months has brought the valuations of Asian high yield bonds down to very attractive levels. The sector is now offering the highest yield in the fixed income space. And with the Chinese government also easing some of its policies to prevent contagion across the sector, we believe that sentiment towards Asian high yield bonds could start to improve as we head into 2022. For equities, we are underweight the US and Europe, but we continue to be overweight Japan as we see the Japanese equity market as an attractive region to play the continued global economic recovery given a sharp acceleration in its vaccination rates. We also continue to maintain our overweight positions in Asia ex-Japan and China. China's growth slowdown is currently at a level that the government can no longer ignore. So we can expect to see some policy fine-tuning and also incremental loosening as we head into 2022. And also with valuations at rock bottom levels and China's tech sector likely to see an easing of regulatory pressures, we think that China's equity market has slightly bottomed and could see a strong turnaround in 2022. But at this point, the emergence of Omicron has added one additional layer of uncertainty to our asset allocation decisions. It is still early to draw any conclusions, given that there is a lack of information about Omicron, but what is certain is that the world has reacted a lot faster to Omicron compared to Delta. For Delta, we were slow to react to the variant, which was one of the reasons why Delta managed to spread so widely to many parts of the world. So Omicron's damage to the global economy may not be as bad as feared. Having said that, we expect market volatility to remain high, at least in the short term, and that the best way to navigate this uncertain environment is really to have a diversified portfolio. And if you're not sure how to build a diversified portfolio, then the iFAST DPMS is certainly an option that you can consider investing in. And with that, I conclude my update for this month. Thank you so much for your time and your continued support for iFAST.